Hello everyone and welcome back. Today we move on to a very important but often overlooked topic, and that is accounts and records under GST. Now you might be thinking, why does this matter so much? Well, think of it this way. Every tax liability you compute, every ITC you claim, every return you file, all of that is ultimately backed by the records and accounts you maintain. If your records are incomplete, incorrect, or not maintained as per the law, it can lead to penalties, tax demands, and even prosecution. So, understanding the rules around accounts and records is absolutely critical for every GST registered person. Let's get started. Let me give you a quick overview of what we will be covering in this chapter. As you can see on the screen, there are 5 major topics. First, persons required to maintain books of accounts. Who is legally obligated to do so? Second, accounts and records to be maintained. What exactly needs to be recorded? Third, manner of maintaining accounts and records. How should these records be kept? Manually or electronically? What are the rules? Fourth, period of retention of accounts. For how long must you preserve your books? And fifth, consequences of failure to maintain accounts. What happens if you don't comply? What are the legal repercussions? These 5 areas together give us a comprehensive picture of the GST framework on accounts and records. We will go through each of these one by one. So let's begin with the very first question. Let's start with the most fundamental question. Who is required to maintain books of accounts under GST? The answer comes from Section 35(1) of the GST Act. Every registered person under GST must keep and maintain books of accounts. Notice the word registered person here. This means the obligation applies to anyone who has obtained GST registration, whether they are a manufacturer, trader, service provider, importer, exporter, anyone. Now, the next natural question is, where should these books of accounts be maintained? GST law is very specific about this. The books must be maintained at the principal place of business as mentioned in the GST registration certificate. This is what we call the PPOB, the principal place of business. But what if a person has more than one place of business? Many businesses operate from multiple locations, a head office, branches, godowns. In such cases, books relating to each additional place of business must be maintained at that respective location. So, if you have a godown in another city and it is declared as an additional place of business or APOB in your registration certificate, then records related to that godown must be kept there. Let's understand what exactly needs to be maintained. Section 35(1) gives us a list. Every registered person under GST must maintain a true and correct account of the following items. 1. Production or manufacture of goods. If you are a manufacturer, you must maintain records of the production process. Raw materials consumed, goods manufactured, quantities produced. 2. Inward and outward. Supply of goods or services or both. This means records of all your purchases, what you bought, from whom, at what value, and similarly, all your sales or supplies, what you sold, to whom, at what value. 3. Stock of goods. You need to maintain a proper stock register. What is the opening stock? What was received? What was dispatched? And what is the closing stock? 4. Input, tax credit availed. Every rupee of ITC you claim must be backed by proper records. You must show what ITC was available, what was claimed, what was reversed or lapsed. 5. Output, tax payable and paid. You must show how much GST you were liable to pay on your supplies and whether you paid it. 6. Any other prescribed particulars. This is a catch-all category. The government can prescribe additional records through rules, and those would also need to be maintained. So this is the core list under section 35(1). But wait, there's more. The GST rules go into much greater detail. Let's look at those additional requirements on the next few slides. Let me take you through three important categories on this slide. The first category is records of imports, exports, and reverse charge transactions under Rule 56(1). Every registered person must maintain a true and correct account of goods or services imported or exported. They must also maintain records of supplies on which reverse charge mechanism or RCM applies. That is, supplies where the recipient is liable to pay the tax instead of the supplier. Along with these records, the relevant supporting documents must also be maintained. This includes invoices, bills of supply and delivery challans, credit notes and debit notes, receipt vouchers, payment vouchers, and refund vouchers. These documents are not optional. They are legal evidence of your transactions under GST. The second category is records of advances received, paid, and adjustments under Rule 56(3). Under GST, tax liability can arise even on advances received before the actual supply happens. Therefore, every registered person must maintain a separate account showing advances received, advances paid, and how those advances have been adjusted against subsequent supplies. The third category is records of suppliers, customers, and storage locations under Rule 56(5). You must maintain complete details of suppliers, names, and full addresses of everyone from whom you received taxable goods or services. Similarly, complete details of customers, names and addresses of persons to whom you have supplied goods or services, wherever required. And importantly, storage location records, full addresses of all godowns, warehouses, and other premises where goods are stored, including goods in transit. This is a very comprehensive requirement. It ensures traceability and transparency across the entire supply chain. Now, some records are required only from regular dealers, not from composition dealers. Let's understand what those are. The first special requirement for regular dealers is under Rule 56(2). Details of stock of raw materials, finished goods, and scrap. Every registered person, except a composition dealer, paying tax under Section 10, must maintain accounts of stock for goods received and supplied. And these stock records must contain very specific particulars. What must the stock record show? Opening balance. What stock did you have at the start? Receipts and supplies. What came in and what went out? Goods lost, stolen, destroyed, or written off, because these also affect your ITC eligibility. Goods disposed of as gifts or free samples. Again, GST implications arise. And finally, the closing balance stock, including raw materials, finished goods, scrap, and wastage. Why is this record so important? Because the stock register helps the department verify whether ITC claimed matches the goods actually received and whether there are any unexplained differences in your stock. The second special requirement is under Rule 56(4). Details of output tax, input tax, and related documents. Again, only for regular dealers, not composition dealers. This record must include tax payable, including tax payable under RCM under sections 9.3 and 9.4, tax collected and paid, input tax and ITC claimed. Together with these, registers must be maintained for tax invoices issued and received, credit notes and debit notes, and delivery challenges, all for each tax period. Essentially, a regular dealer needs to maintain a robust register that tracks the complete tax life cycle for every transaction. GST recognizes that different categories of registered persons have different business activities, and accordingly, specific record keeping requirements apply to each. First, agents under Rule 56(11). An agent, as defined in Section 2(5) of the CGST Act, is someone who carries out supply or receipt of goods or services on behalf of another person, called the principal. An agent must maintain authorizations received from each principal for receiving or supplying goods or services, details of goods or services received on behalf of each principal, their description, value, and quantity, details of goods or services supplied on behalf of each principal, again, description, value, and quantity, accounts furnished to each principal, and tax paid on receipts or supplies made on behalf of each principal. Why is this so detailed? Because in an agency arrangement, the goods legally belong to the principal, but the agent is handling them. GST wants full transparency on what the agent is doing on whose behalf. Second, manufacturers under Rule 56(12). Every registered person engaged in manufacturing must maintain monthly production accounts. These accounts must show quantitative details of raw materials or services used in production and details of manufactured goods, including waste and byproducts. This is very important. In manufacturing, a lot of GST revolves around input-output ratios. If the department suspects that you consume more raw materials than you should have for the given output, it raises a red flag. Monthly production accounts help resolve such questions. Third, service providers under Rule 56(13). Every registered person supplying services must maintain accounts showing quantitative details of goods used in providing services, input services utilized, and the services supplied. For a service provider, this helps track the correlation between inputs consumed and services rendered. Continuing with other specific categories of persons under GST, we have two more important categories on this slide. First, works contractors under Rule 56(14). A works contractor is someone who executes a contract involving supply of both goods and services. For example, construction contracts. Under GST, a works contract is treated as a supply of services. Because works contracts are complex, they involve multiple parties, multiple transactions. The law requires separate accounts to be maintained for each contract. What must these accounts contain? Names and addresses of persons on whose behalf the contract is being executed. Details of goods or services received for executing that contract. Description, value, quantity. Details of goods or services actually utilized in executing the contract. Description, value, quantity. Payment details received for each works contract, and names and addresses of suppliers from whom goods or services were procured for the contract. You can see that this is essentially a project-wise accounting requirement. Every works contract must have its own set of records so that input and output can be traced precisely. Second, custodian or clearing and forwarding agent under Rule 56(17). Any person who has custody of goods, such as a carrier, clearing agent or forwarding agent, for the purpose of delivery or dispatch on behalf of a registered person, must maintain true and correct records of all goods handled by them, and they must produce these records whenever required by the proper officer. This provision ensures accountability not just for the owner of goods, but for everyone who is in physical possession of the goods at any point in the supply chain. It prevents situations where goods disappear without any trace in the records. Now let's talk about a very important provision. Section 35(2) and Rule 58, which deals with warehouse and godown operators and transporters. Section 35(2) states that every owner or operator of a warehouse or godown and every transporter, whether or not they are registered under GST, shall maintain records of the consignor, consignee and other relevant details. Notice something crucial here. This obligation applies even if the transporter or warehouse operator is not registered under GST. So registration is not a prerequisite for this record keeping obligation. Let's look at what transporters must specifically maintain under Rule 58(4). A. A transporter must maintain records of goods transported, delivered and stored in transit, and GSTIN details of the registered persons who are senders and consignees for each of their branches. And what about warehouse or godown operators under Rule 58(4)(b) and 58(5)? Every owner or operator of a warehouse or godown must maintain books of accounts showing the period for which each consignment of goods was stored in the warehouse, particulars related to dispatch, movement, receipt, and disposal of goods. Additionally, goods must be stored item-wise and owner-wise, meaning you can't just pile everything together. You need to be able to identify what belongs to whom. And crucially, the warehouse owner must facilitate physical verification by proper officers whenever required. This is really about making the warehousing industry accountable under GST. When goods are stored in a warehouse, they are often in transit or awaiting supply. The department needs visibility into who owns what and where goods are at all times. Now, since we said that the obligation to maintain records applies even to unregistered transporters and warehouse operators, a natural question arises: how do they identify themselves in the GST system? This is addressed through the enrollment mechanism. If a transporter or warehouse operator is not registered under GST, they must obtain a unique enrollment number by submitting Form GSTENR-01. This is not a registration, it's an enrollment. Think of it as a way for the department to track and identify them, even though they may not have a taxable turnover requiring registration. An important convenience feature: once enrolled in one state or union territory, the same enrollment number is valid for all other states and UTS. So a transporter operating pan-India doesn't need to enroll separately in every state. Also, if any details in the GSTENR-01 form change, say a new address or contact details, The operator or transporter must update the form electronically. Now, there is one more provision for large transporters who operate in multiple states. Under GST NR-02, transporters who are registered in more than one state or UT under the same PAN can apply for a unique common enrollment number or UCEN through GST NR-02. Once the UCEN is issued, it must be used instead of the individual GSTIN for all transport-related activities. This simplifies operations for multi-state transporters and gives the department a single identifier to track them across the country. Now let's talk about how these records must be maintained. GST law gives two options: manual records and electronic records. Let's understand each. Manual records. If you are maintaining records manually in physical books or registers, each volume of the books must be serially numbered. This is to prevent tampering or replacement of pages. Simple but important. Electronic records. You can also maintain records in electronic form. This includes data stored on computers, servers, cloud systems, or any other device. But electronic records come with their own requirements. They must be authenticated with a digital signature. A proper electronic backup must be maintained so that records can be restored in case of loss due to accidents, system failure, or natural disasters. And there are important obligations around producing and accessing electronic records. The registered person must produce records on demand, either in hard copy or electronic format. They must provide details, passwords, and explanations for accessing the electronically stored data. And they must be able to give a sample printout of stored information if required by the officer. This is important to understand. Just having digital records is not enough. You must ensure they are accessible, authenticated, and backed up. Now, let's talk about restrictions on editing or erasing records. This is a very critical provision. Entries in books of accounts must not be erased, effaced, or overwritten. If you made a mistake, you cannot simply white it out or delete it. What you should do is score out the incorrect entry. That means draw a line through it, then attest it, and record the correct entry alongside. For electronic records, the rule is slightly different but equally strict. A log of every edited or deleted entry must be maintained. So even if you correct a figure in your accounting software, there must be an audit trail showing what was changed, when it was changed, and what it was changed to. This is what makes GST records tamper-proof. The law does not allow you to hide your mistakes. You can only correct them transparently. Now let's move on to the fourth major topic. For how long must you preserve your records? This is governed by Section 36 of the GST Act. The standard retention period. Every registered person must retain books of account and records for 72 months, that is 6 years, from the due date of furnishing the annual return for the relevant financial year. Let's make this concrete with an example. Suppose the annual return for FY 2023 to 24 is due on 31st December 2024. Then your books for FY 2023 to 24 must be retained until 31st December 2030. That's 72 months or 6 years from that due date. Now, there is also an extended retention period. When can your retention obligation extend beyond 6 years? There are two situations. Situation 1, where an appeal, revision, or legal proceeding is pending before an appellate authority, revisional authority, tribunal, or court. As long as the matter is unresolved, you must keep your records. Situation 2, if the registered person is under investigation for any offence under Chapter 19 of the CGST Act, which deals with offences and penalties. In either of these situations, the records must be retained for the later of two periods: 1 year after the final disposal of the appeal, revision, or investigation, or 6 years as per the standard retention period. Whichever is later, that is the applicable retention period. The logic here is sound. How can you defend yourself in an appeal or investigation if you don't have your records? The law ensures you can't conveniently lose records while proceedings are ongoing. Continuing with the preservation theme, Rule 56:16 prescribes specific requirements for what must be preserved and how it must be accessible. Every registered person must preserve all records, and this includes a wide range of documents: invoices, bills of supply, credit notes, debit notes, and delivery challenge, stock records, inward and outward supply records. Essentially, all the records we have been discussing throughout this chapter must be preserved for the retention period we just discussed. Now, how must they be preserved? If records are manual, physical books and registers, they must be kept at every registered place of business. If records are digital, stored electronically, they must be accessible from every registered place of business. This is an important distinction. For digital records, you don't need a physical copy at every location, but the system must be set up so that an officer visiting any of your registered locations can access and view the records. And finally, there is a general obligation to produce records whenever required under any law in force, not just GST, any law. So, if an income tax officer, a customs officer, or any other authority requires your GST records as part of their proceedings, you are legally obligated to produce them. This cross-law accessibility requirement reinforces the idea that GST records are not just for GST purposes, they are financial records with wider legal significance. We've now reached the final and perhaps the most impactful topic. What are the consequences if a registered person fails to maintain proper accounts? This is covered under Section 35(6) and the relevant rules. Situation 1. Undeclared goods liable to tax under Rule 56(6). If a registered person fails to account for goods or services as required under Section 35(1), meaning there are goods or services for which no records exist, the proper officer will take action. The officer shall determine the tax payable on those unaccounted goods or services, treating them as if they were supplied by the registered person. The officer will then apply the provisions of Section 73 or Section 74 for tax determination. Section 73 applies when there is no fraud. Section 74 applies when there is fraud, willful misstatement, or suppression of facts, and that carries much heavier penalties. Situation 2. Books of accounts found in undeclared premises under Rule 56(10). What if taxable goods are found stored at a location that was not declared by the registered person under Section 35(5), and there are no valid documents for those goods? The proper officer shall treat such goods as having been supplied by the registered person and determine the tax payable on them. In other words, undeclared storage is treated as undeclared supply. Situation 3. Presumption regarding books found at undeclared premises. If any documents, registers or books of account related to a registered person are found at a premises not mentioned in the certificate of registration, the law presumes that those records belong to that registered person. And here's the critical part. The burden of proof is on the registered person to disprove this presumption. So, if your records are found somewhere unexpected, say at a relative's address or an unregistered godown, you have to prove they don't belong to you. That is a very difficult burden to discharge. These three scenarios highlight why maintaining records at declared premises with proper documentation is not just a compliance formality, it is your legal protection. Alright everyone, we've covered the entire chapter 11 on GST accounts and records. Let me quickly recap what we learned today. We started with who must maintain records. Every registered person at the principal place of business or additional places as declared in the registration certificate. We then saw what must be maintained. The core list under section 35(1) covering production, supplies, stock, ITC and output tax, plus additional requirements under Rule 56 for specific categories like agents, manufacturers, service providers, works contractors and custodians. We also understood how records must be maintained, whether manually or electronically, and the strict rules against erasing or overwriting entries. We discussed the period of retention, 72 months as the standard period, extendable in cases of appeals or investigations. And finally, we saw the serious consequences of non-maintenance, tax demands, penal proceedings, and the reversal of burden of proof. Remember, in the world of GST, your records are your defense. Maintain them correctly, keep them for the prescribed period, and ensure they are always accessible and authentic. In the next chapter, we will continue our journey through indirect tax. Until then, practice what you've learned, and if you have any doubts, feel free to revisit this video. Thank you, and keep learning.